Welcome back to Confident Real Estate. I'm your host, JC. Today, we're going to get right into it. We're going to be discussing how to use your 401k to build your real estate portfolio. Trust me, you are going to want to watch this video all the way to the end because we're going to unveil a strategy that, for some reason, I've never personally seen covered on any YouTube video. There are plenty of videos that talk about investing with your 401k, but not using the real estate investing strategy we're about to uncover. You are definitely going to like this video and you're going to want to bookmark it. And while you're at it, since it's the only thing I ask of you in return for all the research I'm doing and me giving you all this information, just please hit that like button down below and feed the YouTube algorithm and help our channel out. Fair enough, right? The truth of the matter is that for the vast majority of us, a 401k, even with your employer's matching contribution, if offered, is not likely going to provide us with enough income to live the life we plan to live once we hit that age of retirement. With the average human being living longer than any human has in recorded history, it's hard to say exactly how much each of us is really going to need to put away in order to live a comfortable life in retirement. Comfortable being the key word. The last thing you want is to finally reach those golden years and find out you need to live more frugally and cut back on your expenses more than you have at any other point in your life. That's not what we picture when we typically picture the golden years of our lives. But unfortunately, the current reality for far too many people in what we call the baby boomer generation, who are now reaching the point of retirement and are ready to start enjoying life, they're suddenly finding out that might not be an option for them. So what's the point of a 401k? It's supposed to give you income and cash flow and cover your monthly expenses once you retire and replace the income that you used to receive when you were working full-time. But what is a 401k typically invested in? It's a mixture of mutual funds, stocks, bonds, and other low-yield fixed income assets. And typically, as you get closer and closer to the point of retirement, they shift the 401k plan to become more and more conservative in how it invests, meaning less risk and a lot less reward. But what happens if you're within the final 10 years before your planned age of retirement and suddenly we get hit with another recession and it wipes out a lot of your hard-earned savings and years of compound interest earnings that you've accumulated? Then what? We all know that typically the market has historically always gone up, but will it go up quickly enough during the period of time that you need it to before you hit that age of retirement? Will your dreams of world travel suddenly turn into weekly trips to the local senior center instead? The one thing your 401k is not invested in is a tangible asset like real estate that gives you both cash flow and equity appreciation. The level of control you have over your investment in a piece of real estate is far superior to an investment that you have in a fund that's being managed by somebody else and invested in the stock market. So why not replace your current income with cash flow from your real estate portfolio, and then you can decide whether or not you're going to retire early. Another huge advantage to real estate is that your principal balance of your investment is much better protected. In a typical 401k scenario, if your principal balance takes a significant hit, then it's going to get wiped out and you're going to have much less invested to actually earn any interest on. Where with real estate, your principal investment is tied up in an actual physical, tangible piece of property. And therefore, while the value might go up or down slightly, it's not going to be subjected to the extremes that your 401k investments in a stock market setting are going to be subjected to. And for the most part, your cash flow is probably going to remain fairly consistent with real estate. So what prevents most people from investing in real estate? Well, it's a lack of cash, a lack of extra money to spend on a real estate investment, the seed capital that most of us need. But what about that 401k that you've had money pulled from your paychecks to go into for however many years? Let's look at what type of 401k you have and whether or not you can pull some cash out of it now to invest in real estate so that you can retire faster and much more comfortably. First up is the rollover 401k, which typically exists if you had a 401k at a prior job and then you left that job and rolled over your 401k. Now, you may have a current 401k at your new job if you went and started a 401k somewhere else, and you probably won't be able to touch those funds from the new 401k. It's not impossible, but it's not easy. However, that rollover portion of the 401k can be accessed now. The only thing you have to do is pay the taxes on it and what's called a early withdrawal penalty, which is currently about 10%, but that's only applicable if you're under 59 and a half years of age. Now, that may sound terrible, but let me point something out to you that one of the top financial advisors in the country once shared with me. Do you think that the tax rate is going to be lower in, say, 10, 20, or 30 years when you're finally ready to withdraw that 401k money? Or is it likely lower today than it will be when you're ready to retire? The 10% early withdrawal penalty may hurt, but let's keep things in perspective. You're going to be paying less taxes now than if you wait until your planned age of retirement to do your withdrawal. In addition to that, if you take your money and invest it in real estate, it's a strong bet that you're going to make greater returns and stronger and more consistent cash flow from your real estate investments than you would have gotten out of your 401k. So in the long term, you're probably not going to care too much about that 10% penalty. Now, if you have a solo 401k, otherwise known as a self-directed 401k, then you have some real options at your fingertips. Because a solo 401k means you, rather than your employer's fund manager, are directing the investments of your savings in your 401k plan. Accordingly, you can borrow money from your self-directed 401k for any investment that you choose. However, there are, of course, some rules to it. You can borrow up to $50,000 or half of your 401k balance, whichever is lower. So if you only have $50,000 in your 401k account, then you can only borrow $25,000, which is half of 50. However, if you have $250,000 in your self-directed 401k, then you can borrow up to $50,000, which is the cap. You're going to have 5 years to pay back that loan. And you're going to be paying some principal and some interest because it is a loan after all, and you have to show the IRS that this is a real loan. So you should probably put some form of written document together, it doesn't have to be anything crazy, to show that this is how you plan to repay that money, and you have to make at least one payment every 90 days. If at the end of the 5-year term, you haven't fully repaid the loan, then the IRS can come in and audit you, and anything that you've yet to pay back at the end of the 5-year term is going to be counted as a taxable distribution, which means it's subject to taxes and that early withdrawal penalty of 10%. This can be a wonderful way to finance a real estate purchase, or perhaps to finance the rehab portion of your investment in a real estate property that you already purchased either under your own name or under an LLC or some other arrangement. You can also just buy a piece of real estate outright from your self-directed 401k account, but again, this comes with a set of rules attached. In full disclosure, you should always consult with your accountant or your financial professional before you invest in a piece of real estate using your 401k account. You just want to avoid any hiccups that could have the IRS breathing down your neck with a potential audit. There are many rules to how to structure this, and I'm going to cover the basic material points that you have to know to decide whether or not this is the right course of action for you and your investments in real estate. But again, talk to your accountant or your financial professional before you actually pull the trigger, just to make sure you're covered. Most importantly, when buying a piece of real estate using your self-directed 401k, everything has to be done through the actual name of the 401k account, and all the money has to come from the actual 401k account. You cannot in any capacity use personal funds, or you have destroyed this whole deal and you're going to pay some taxable distributions when the IRS comes calling. So what this means is you have to go and open a bank account in the name of your 401k account, not in your name, in the name of the account that is set up for you. You also have to make sure the 401k account is the actual purchaser and the only name that appears on any of the documents related to the deal. That means the contract of sale, the purchaser is going to be your 401k account, not you. You'll be signing as a trustee. That's your capacity within the deal. You're signing as trustee of your 401k account, but your 401k account is the only name that appears on any of the documents. Accordingly, you're also going to make sure your 401k account is the only person, or entity rather, that is paying any of the expenses. So the inspections, the attorney's fees, broker commissions, the down payment on the contract is all going to be paid by your 401k, not coming out of your pocket using personal funds. At the end of the day, when you take title to the property, the deed is going to say the purchaser is your 401k account. And again, you'll be signing any documents related to the closing as a trustee in charge of your 401k account, which is the purchaser. It's the same as if you purchase a property under an LLC. The LLC is going to be the owner of the property. You're signing as the managing member or whatever your title is under the LLC documents. Contributions into your self-directed 401k account for the purposes of this real estate purchase have to come from rollover accounts, other qualified plans, or your pre-tax deposits into the account, but cannot come from your personal funds to finance the deal. You can't take money out of your checking, put it in your self-directed 401k account, and then say, hey, I'm buying the property with a self-directed 401k. If you do, the IRS is going to come calling and it's going to be considered a taxable distribution, which means it's going to be subjected to those penalties for early withdrawal and the taxes that we keep mentioning. I hope you're picking up on the pattern here. Don't use personal funds. Now, the downside is that you have to buy the property for cash. You cannot have a mortgage or any other type of debt financing in the structure for buying the property. However, that said, that does not mean your self-directed 401k must pay 100% of the purchase price for your real estate investment. Your 401k can be part of a tenancy in common structure. You can set up a straightforward tenancy in common and have your self-directed 401k purchase a membership interest in the property, and then you as an individual or under an LLC can take money out of your savings and money that you've put aside for an investment and also buy a tenancy in common membership percentage in the property. In addition, you can go and find family and friends that may also have similar retirement accounts set up, and they can each come in and buy a tenancy in common membership percentage interest in the property. And then each of you as tenants in common buy a certain percentage of the total acquisition until you've hit 100% of the cost to buy the property. Now you've got friends and family invested with you. You invested in your 401k capacity, and maybe you invested personally using funds from your checking and savings account. Each of you is a tenant in common. Cumulatively, you bring enough money to the table to reach 100% of the purchase price without any mortgage or third-party financing. You're in the clear. You're good to go. And now you've been able to use the money you've been putting aside for your retirement in a much better instrument of investment called real estate than the stocks and low yield fixed income assets that your employer's fund manager was putting your money into and then charging you a fee for managing. Just make sure that whichever option you choose, you keep your 401k funds cleanly segregated from other funds in your account, and that you keep thorough books of accounting throughout the entire investment so that just in case one day the IRS comes knocking on your door looking for a reason to classify your investment as a taxable distribution subject to taxes and early withdrawal penalties, you have all the books and records and segregated accounts to show them this was a valid and properly done investment. And thank you very much for checking, but there will be no audit here that comes out with a classification of distribution, penalties, and taxes. We're still in the good. Once again, I appreciate you watching this video all the way to the end. If you haven't done so already, please hit like on this video and hit subscribe if you haven't yet. I hope you really got something beneficial out of this video, possibly a game changer for your real estate investing strategies. Please don't forget to follow us on Instagram as well, where we post some relevant news stories that are related to the videos that we post, as well as updates announcing when we post our next video. Again, if you want to pursue something that's worth doing in life, always remember that where there's a will to do it, there is bound to be a way. Don't ever get discouraged. I promise you, everything that you dream of doing in life can be done if you plan for it accordingly. Until next time, I'm JC, and this is Confident Real Estate.